Welcome back to Investing Talk Podcast.
Today we're looking at 1-800-Flowers.
A classic company, but one that's facing a massive high-stakes pivot.
Absolutely.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis.
Let's do it.
When you're looking at a story like this, a turnaround play, you have to start with the bear case. You just have to.
You have to understand why the stock is so beaten down in the first place.
Well, exactly. You need to really internalize the severity of the financial wounds before you can even think about a recovery.
Okay, so let's unpack that. The recent numbers show some pretty serious deterioration. How bad are we talking here?
They're deep and they're broad. The biggest problem is just a general weakness in discretionary spending.
People are pulling back.
Right. For fiscal year 2025, revenue declined 8.0% year over year. It dropped to about $1.68 billion.
And that wasn't just in one area.
No, that's the key. It wasn't just flowers. This was a broad-based weakness that hit everything. Gourmet foods, gift baskets, you name it.
So when consumers feel squeezed, gifts are one of the first things to go.
That's the dynamic. And 1-800-Flowers is, highly exposed to that.
So lower volume, less revenue. That immediately puts pressure on profitability. But the margin hit, that looked catastrophic.
It wasn't just pressure. It was a massive contraction. Adjusted EBITDA.
Right, the key operational number.
Plummeted from $93 million down to just $29 million.
Yeah.
The volume decline hurt, sure, but it's the fixed costs of running that big legacy infrastructure that just amplifies the pain so quickly.
And we can't talk about those numbers without talking about that huge non-cash charge, the elephant in the room.
Exactly. The decline looks even worse because of this massive non-cash impairment charge of $138.2 million.
Okay, help us unpack that. What does a $138 million goodwill charge really signal to the market?
It signals a recognition of failure, plain and simple.
So, past mistakes.
Yes. When a company buys another company, the amount they pay over the fair value of the assets gets booked as goodwill. That write-down, most of it tied to goodwill and the Personalization Mall brand name, is the company basically admitting those past investments are not generating the returns they expected.
They're wiping value off the books.
They are. And while it's a one-time accounting thing and doesn't hit cash flow today, it tells you that the prior management strategy of acquiring growth just wasn't working.
A powerful indictment. And this operational slide continued right into this year.
It did. The most recent Q1 for fiscal 2026 was a big miss, a loss of $53 million.
Wow.
Now, you have to remember, Q1 is always seasonally weak for them. It's only about 14% of their annual revenue.
But still, that size of a loss?
It missed Wall Street expectations and just confirmed that this demand weakness is, sticky.
Okay, so sales are dropping, margins are getting crushed. Which brings us to the lifeblood of any company, cash flow. If they're burning through cash, this whole transformation story is a non-starter. So how bad is the picture there?
It's not good. Free cash flow, or FCF, it completely reversed in FY 2025.
From positive to negative?
To negative $67.8 million. This is really concerning, especially for a seasonal business.
Why, especially for them?
Well, it reflects the revenue drop, of course, but also the timing around the huge Q2 holiday working capital cycle. They have to spend money now to stock up for the peak holiday quarter.
And if that peak doesn't show up?
You're left with negative cash flow and a huge inventory problem.
So the market has basically priced this thing for a long-term structural decline. The stock price is reflecting maximum fear.
That's the picture.
So where does the bull case, the turnaround story, even begin? What's the catalyst for any kind of hope here?
The catalyst is a pure high-stakes operational turnaround.
Yeah.
And it's driven entirely by human capital.
Meaning new people.
New people at the very top. The company realized the old way was failing, and they've repositioned around modernization and this celebrations customer-centric model by, frankly, gutting the C-suite and bringing in outside talent.
It sounds like they finally admitted their tech and their entire marketing engine were just not built for the modern consumer.
Precisely. They're placing their future in the hands of two key high-conviction hires. First, they brought in Alexander Zelikowski as the new CIO.
And he has a serious background.
Oh, yeah. He has digital transformation credentials from places like Amazon and Pitney Bowes.
Bringing in someone from Amazon, that's a huge statement. It basically screams, we have massive legacy tech debt, and we need someone who knows how to build a modern e-commerce machine.
That's his mandate. Overhaul everything, IT applications, data architecture, cybersecurity. But the real key is a heavy focus on AI and business optimization.
So moving from old manual systems to something hyper-efficient.
That's how you start to fix those margin problems we talked about.
Okay, that addresses efficiency. But what about the top line? You can be the most efficient shrinking company in the world and still fail.
Right. And that's where the second key hire comes in. Melanie Babcock, the new Chief Marketing and Growth Officer, her job is to get their marketing away from just, broad, inefficient spending.
It's like blasting coupons to everyone.
Exactly. And move to a data-driven customer lifetime value model.
I saw her mission is to build a full funnel flywheel. For those who aren't in digital marketing, what does that actually mean for a company like this?
It's about precision. It's the difference between sending a generic email and using AI to figure out which customer is about to buy, what they're going to buy, and when.
So better acquisition costs.
Much better. And maybe more importantly, boosting customer retention. If you can get customers to come back for birthdays, anniversaries, not just the big holidays, you stabilize the entire revenue base.
This sounds like a pretty fundamental shift, not just a cosmetic change, but I think you mentioned a tiny green shoot of hope even before these new leaders really got started.
That's what the bulls are clinging to. A small revenue beat in Q4 of FY 2025. It was only 1.77% above consensus, but it hints that maybe, just maybe, demand is starting to stabilize.
It gives the new team some breathing room.
A crucial psychological boost. It suggests the bottom isn't infinite.
Okay, but this kind of transformation is expensive. You've got negative cash flow of almost $70 million. Can they actually afford this pivot?
This is where the story gets interesting, and where the financial foundation is a huge mitigating factor.
How so?
As of the end of June 2025, they paid down all of their revolving borrowings. They had $46 million in cash and zero outstanding on their revolver.
Zero revolving debt. Okay, that is massive. In a distressed situation, that preserves capital.
It's everything. It means they don't have immediate suffocating pressure from banks. They don't need to issue costly debt just to keep the lights on.
It buys them time.
It buys the new leadership time to execute their plan. The failure condition becomes about execution, not about solvency.
Let's shift to the competitive landscape then. This is an old brand. What's their moat? What unique advantages might shield them while this big internal pivot is happening?
Their main defense is diversification. People still think of them as just the flower company, but the real strength is a portfolio.
Consumer floral, gourmet foods?
And critically, the B2B segment, BloomNet.
Tell us more about BloomNet. That sounds like the anchor in the storm.
It's a vital structural advantage. BloomNet is essentially a wholesale and logistics network for local florists all over the country.
So it's not just selling to us, to consumers, it's part of the supply chain.
Exactly. It creates powerful network effects and switching costs. The more florists rely on BloomNet for ordering and logistics, the more indispensable it becomes.
And that B2B revenue is probably more stable.
It's recurring and much less susceptible to the wild swings of e-commerce competition. It acts as a stabilizer while they rebuild the consumer side.
And they're also making some small bolt-on acquisitions.
Right. Disciplined moves. Bringing in premium brands like Scharfenberger chocolates and card aisle greeting cards.
Expanding the gifting ecosystem.
The goal is to capture a bigger share of your wallet during those key seasons. Mother's Day, Valentine's Day, get you to buy the flowers, the chocolates, and the card all in one place.
So stable foundation, a B2B moat, and new digital talent. Yet the stock is trading around $4.44, down over 50% from its 52-week high.
And this deep decline is what puts the valuation at what analysts are calling a capitulation level. The market is pricing in absolute failure.
To put it in perspective,
The company trades at a price-to-sales ratio of 0.2 times. The industry median is 0.5.
a price to sales of 0.2 means the market is valuing the entire company at just 20 cents for every dollar of revenue it makes.
That's the implication. It assumes financial distress or collapse that just doesn't line up with their debt-free revolver and cash position.
And that's where the asymmetric upside comes from, if the turnaround works.
That's the bet. You're buying decades of brand recognition and infrastructure for a fraction of its historical value.
But that potential comes with huge risks. Let's tackle the two big ones that could derail this whole story.
First and most immediate is just pure execution risk. New management has to deliver, and they have to deliver quickly. Appointing a high-profile CIO is step one. The hard part is actually doing it.
Overhauling the systems, integrating AI, making the marketing work.
The market has absolutely zero patience left.
And the second risk? That's more external, right?
It's the risk of structural decline just continuing. Despite the brand diversification, if consumer spending stays weak, or if these slick digital native gifting companies keep stealing market share.
The core business could shrink faster than they can fix it.
Exactly. And analysts are still forecasting another 4% revenue decline for this year. So the new team isn't just fixing internal problems, they're fighting a structural war.
Okay, this high-stakes bet on leadership, a clean balance sheet, and a B2B moat versus intense competition. It has to come to a head soon. What's the one date we should circle on the calendar?
The critical catalyst is the Q2 fiscal year 2026 earnings release. That's expected in February 2026.
Why that quarter specifically?
Because Q2 is everything for this company. It's their highest volume, strongest seasonal quarter. It accounts for 46% of their entire annual revenue.
It includes the peak holiday season.
Right. If they fail to deliver in Q2, they will miss their annual targets badly, and the stock will get crushed all over again.
And this will be the first full quarter where the new CMO's initiative should really start to show some traction.
Precisely. If they show sequential revenue stabilization, and crucially, some margin improvement from that new marketing efficiency, the whole narrative could flip overnight.
But if Q2 is weak,
The market will just conclude the new talent wasn't enough. It's a pass-fail test.
so we have an established brand, valued like it's going out of business, but with a solid debt-free balance sheet to fund a massive transformation. The whole thesis hinges on whether this new digital leadership can execute by February.
What's so fascinating is just how cheaply the market is pricing a brand that still has that strong B2B moat and has attracted top-tier talent. The current price assumes the turnaround fails.
But the potential upside.
It's enormous if they can just deliver stabilization. It's a really powerful setup for a value investor who's willing to make a bet on human capital.
A very high-stakes story we will definitely be watching. If you want more analysis like this, make sure you subscribe to Investing Talk podcast for our next breakdown.